Perfect. Okay. Well, first of all, I want to thank everyone for joining us today. Our goal today is to show how easy affordable housing is and allow you as a real estate agent to feel comfortable about accepting sales contracts on affordable housing. My name is Sherri Bennett, and I'm an account manager with Mountain West Financial. I have been with Mountain West Financial for 30 years. I'm sorry, I've been with Mountain West Financial for 22 years. I've been in the industry for 30 years. I would like to introduce to you two of my guests, my first two guests. It's Angie King and Tonya Todd.
Hello.
Okay. Hi.
Hello, everybody.
Once I figure out now how to do this, oops. How come it's not going for me? Sorry, Tiffany. Oh, there we go. Okay. Angie King is our Senior VP of Credit Risk. With over 30 years of experience in the real estate industry, Angie has a wealth of knowledge in underwriting and credit risk. She has been with MWF for 19 plus years, where she has managed teams from underwriting, retail, and wholesale to running a wholesale operations. Angie loves the culture of MWF and the ability to make home ownership a reality. She enjoys spending time with her family and loves hockey. And I'm so sorry, I need to get rid of something. Okay, Tonya Todd. Oh, come on. I'm so sorry. Okay, so oh, I am so sorry I'm messing this whole thing up.
No, you're good. Just
You're fine.
back here.
I
Yeah.
cannot go back to the other.
It's okay. We can just dive right in.
Okay, sorry,
Yeah,
Tonya.
there you go.
I am so sorry. I had everything prepared.
You're good.
So we will be discussing the 10 down payment assistant myths. Before we get started, I would like to ask everyone to hold on to your questions until the end. We will give time to answer all questions then. The first myth, I need 20% down. So Angie, do we need 20% down on a home loan?
No, you do not. So when it comes to down payment assistance programs, you obviously have a first mortgage, which carries a second mortgage. So say you're doing an FHA loan. The FHA requirement is 3.5%, right? So most cases, you have a DPA that covers the 3.5%. So your down payment is already covered. A lot of these programs, there's so many programs in our wheelhouse, but the programs, offer 2%, 3%, 4%, 5% as a second. So your down payment is covered in all those instances with some additional down or additional funds for closing costs, say.
And Tonya, do you have anything to add?
Sure. I think, that everybody on this call probably knows, the mortgage options, the FHA with the 3.5 and USDA, you can get in with no money down, VA same, conventional 3 to 5% down. We're all mortgage professionals. I think, the key thing take away with this myth is most home buyers feel that this is still the case. And, it's still one of the most common myths out there. And it's our job as the lending community to help educate, what available loan options there are. Your traditional mortgage options, you don't even need to have, the 20% down. But like Angie said, there's also down payment assistance programs that help you can get in with no money down. I think, what scares a lot of renters out there is that they have to have, 20% down, and it keeps them in, lifelong tenancy. And, to make matters worse, rents in, major cities continue to climb, and a lot of these renters, it just compounds the situation because they think they'll just never have the money to get that 20% down. So it's our job to educate them that there's options out there that might be even more affordable, especially with those rising rents. But yeah, I think that covers that one.
Wonderful. Thank you. Let's go on to our next myth, number 2. I make too much income to qualify. Tonya, you want to start this one off?
Sure. This myth kind of dates back to when a lot of housing finance agencies did bond loans, mortgage revenue bonds, and lenders might be accustomed to low income limits. Today, there's a variety of down payment assistance programs, some that are bond that do have low income limits to help those borrowers, but there's a variety of down payment assistance programs with very, very high income limits, with those making all the way up to 140% AMI. An AMI is average area median income. Back in the day, the bond programs would limit down payment assistance programs to those making 80% of the area median income. So if you haven't looked at down payment assistance programs in a while, that myth is out the door. There are plenty of options that have higher income limits. Very generous.
And and Angie, do you have anything?
Yeah, in addition to that, it used to be, and in most cases, where you have to use household income to qualify. So those income limits is based off everybody in the household, but that is a myth. Most programs go off qualifying. So even though a borrower may be thinking, oh, with my bonus and with my commissions or with my overtime, I make too much money, that's not always the case. If you can qualify without that income, the income limit would go off qualifying income. So you have some wiggle room there, as long as you're meeting ratios, of course, but you don't have to always use all income.
That's absolutely right. And that kind of goes back to what I was saying earlier about the MRB income limits. And there may be some states where they offer both. So, in those programs that offer the old bond guidelines, you would have to use that a bond qualifying income. But like Angie said, there's so many programs out there that go off the lender qualifying income, and they have even higher income limits. So it's a double bonus.
Yeah, double bonus.
Awesome. Okay, so now we're on to myth number 3. It takes 60 to 90 days to close down payment assistant loans. Angie, want to start this one off?
Okay, I'll just say no. That, I mean, everybody lives in the dark ages, I guess, and to some degree. And when DPAs first came out, everybody has to get used to how their premises of when they're going to submit that loan to the investor. Investors or these programs used to require approval on every loan. You can never be delegated. It was on all non-delegation, but that's not the case anymore. Most of these programs, as long as you're approved with them, it's delegated. And in the cases where we do require approval before we can go to docs, it's up to the lender to decide when that file goes for approval, right? You get that loan in line for approval way before you have all your conditions satisfied, as long as obviously you're meeting, your income limits and, your credit is all solidified. But there's no timeline as to when you can submit that loan for approval. So the quicker you do it, the easier the process is. And these loans can close in 30 days. You could still meet those closing times.
And Tonya, do you have anything to say?
I'm sure, not too much more, but it can be true that some of these programs, depending on the requirements, may take a little longer than a typical loan to underwrite, approve, reserve funds, and deliver closing documents, but not that much longer. And in that timeline should be, measured from the date that you do that you need the full down payment assistance. Because the key here is do yourself a favor and research these programs early. If a program has say home buyer education course, if you know that up front, you can go ahead and have your borrower do that legwork before you get into the process. So your housing agencies and lender partners like obviously the realtor partners and lender partners work together, and you should work together and understand what's available and what kind of timelines are needed. But really, it shouldn't be any longer than a typical loan.
Wonderful. Good. On to 4. Okay. Down payment assistance programs are for first-time home buyers only. Tonya, you want to start us off on that one?
Sure. Yeah, I think that goes back to the old days with the MRBs. Those are typically for first-time home buyers. But one of the things that a lot of people are surprised to hear is first of all, the definition of a first-time home buyer. It's anyone who has not owned a home within the last 3 years, typically. So you got to understand what that definition is, because if you've owned a home before but you're currently renting, or your borrower is currently renting, they might be a first-time home buyer again. And, on top of that, not all programs specify that they are for first-time home buyers. They can be repeat home buyers. And if you're familiar with, Down Payment Resource, they track all the down payment assistance programs nationwide. And I looked at one of their last reports, and nearly 40% of all programs nationwide were for, both first time and repeat home buyers. So, just, educate yourself on what's out there, and know that it's not just, first time home buyers forever. It's, the definition, and know that there are programs out there for repeat buyers.
Wonderful. And Angie, do you have anything to add?
Yeah, well, yeah. So you have to look at that definition of first-time home buyer. Every program will be different, but there are programs where you can actually currently own your home as well, or currently own a home, as long as that home is not your primary residence, where you are renting at another location, but you still have that other investment property that you own. Some programs allow for that also. So like Tonya said before, it's about education, looking at the programs, looking at the definitions of, okay, this says it has to be a first-time home buyer, but look at the rest of that definition along with it. Most programs now don't have that restriction.
Great. Okay, wonderful. Let's go on to now myth number 5. I need down payment and closing cost assistance. Angie, you want to start us off?
Sure. It's all about structure, right? So you get into a deal, and what is the seller willing to do first off, right? Because seller contributions are a huge part, which seller contributions go by your first mortgage guidelines. So there's no restrictions in the sense of the DPA saying, oh, the seller can only contribute 2% to this deal. So, you have a seller that can do a 6% contribution, right, for closing costs. So you have your DPA that covers your down payment, say 3.5%. But remember, I had mentioned before, most of these programs don't limit you to just 3% or 3.5% for a down payment. You could go up to 4 or 5%. And then in addition to that, some programs offer grants for the closing costs. So you could combine that with a seller credit. So there are so many varieties of contributions out there. It's about knowing your borrower's needs, looking at the programs, again, education, and seeing what best fits for that borrower.
Great. And Tonya, do you have anything to add?
Yeah, I mean, that's exactly right. There's not much more to add except I think some borrowers are so confused if they have the money for the closing costs or the down payment assistance, that they should, use that and not use the program. But if the program works and it can get you into the home, and you have that savings for other things, like, I don't know, an air conditioning, unit coming apart, using, the down payment programs is not just for those who don't have the funds. If you have funds, you can retain some of that savings for long-term home ownership success. But I think the bottom line, the biggest obstacle is is down payment, and there's programs out there that can give you funds for down payment and closing cost assistance.
Perfect. Great. Okay. Myth number 6. Down payment assistance limits the assets I can have. Tonya, you want to start us?
Yeah, this one's really simple, and I think Angie probably, from an underwriting perspective, can give more here. But usually, the assets requirement is for heavily subsidized programs like deed restrictions, where you're getting into a home for a lower purchase price, things along those lines. They have more strict requirements in how much assets you can have. But for your traditional vanilla down payment assistance program, they really focus on income limitation, and many of the programs that I've seen don't even mention assets. So I think, the misconception here is related to, deed restriction type programs.
Great. And Angie, you want to add?
I agree. There, you don't have a lot of asset limitation with the DPAs. You can keep, like Tonya was just mentioning, the borrower can keep that money in the bank just in case something comes up, needs to repair something in the house. So we don't have those limitations as before.
Wonderful. Good. This is some really good information. Okay, let's move on to myth number 7. I can only buy a home in a down payment assistance designed area. Angie?
And you can, I mean, you can have that perception when you're dealing with community programs, right? If you're dealing with the city of San Bernardino and they have certain programs that they're offering, they're going to obviously serve their community first, right? So you may have cities or areas of San Bernardino that they're only going to offer, but you have to look at all programs. You have state programs, you have national programs, and those programs do not have limitations on where the borrower can go purchase. The borrower could start looking at a home in San Bernardino County and then end up in Riverside County. And as long as you're meeting the guides as far as income limits or debt ratio or credit score, then you're open to any of those cities to buy in. So again, what's affordable for your borrower, but you have to look at those national programs, those state programs.
And Tonya?
Yeah, so every program, there's basic criteria to qualify, and the home buyer and the property must meet that criteria, and depending on who's giving the assistance, whether it's a city, county, or a statewide program, obviously the property location is going to be one of those criteria. But and there's also other programs that have, home buyer criteria where you have to be a teacher or an educator to get that assistance. So just knowing and understanding all the available options, you will expand the box of, of opportunities for your buyer.
Wonderful. Okay, myth number 8. I can only use FHA financing with down payment assistant loans. Tonya?
Yeah, I think that this is a common myth, even among the mortgage professionals. They think that FHA is designed for, home buyers that are, low income. But that is not the case. Ginnie Mae, FHA loans are very popular among the down payment world. However, there are plenty of programs with Fannie Mae and Freddie Mac on the conventional side that are really great options for home buyers, and you can pair the down payment assistance with those product types. It's not just limited to FHA.
Angie, do you have anything to add?
No, I think she said it well. Oh,
great. Wonderful. Okay, on to myth number 9. The sales prices for homes in my neighborhood are too high for down payment assistant programs. Angie, you want to start us off on that?
Sure. So sales price limits. Some programs have them, some programs don't. Again, you have to consider the times, right? Sales prices obviously in a lot of areas are high right now. But these programs look at that. They analyze their areas. They look at where people are buying, and they structure their programs based off the area. So in some cases, you will have sales price limits. You'll have those for, again, designated borrowers, lower income or need more assistance. But in general, you're looking at a bigger picture now as well with, other programs, state funded programs and national programs where they don't have sales price limits.
Great. And Tonya?
I mean, that's exactly right. I just wouldn't let any preconceived idea of a program throw you off, because obviously the borrower's income is going to derive how much they can afford. I work for Hilltop Securities, and we work with the 18 different state HFAs across the country. And just before this call, out of curiosity, I looked at the max purchase price for some of our loans this year, and they ranged all the way up to over nearly $800,000. I've seen in some of our states. So don't let just because the average purchase price might be 250 or 300 doesn't mean that some neighborhoods, like Angie said, that might be in a targeted area that have higher income limits, or you're dealing with a borrower that has a higher income, and the housing agency has a higher income in that particular county. It may not be a statewide limitation. It's adjusted annually based on what's happening in that market, and we've seen what's been going on across the country. People are moving across the country and driving up sales prices all over. So, in high cost markets, it can be much, much higher than what you think.
Great. And now we're on to myth number 10. I need perfect credit for down payment assistance programs. Tonya, you want to start us?
Sure. I mean, obviously, with any program, first mortgage or down payment assistance, the borrower needs to demonstrate, they are financially responsible. And each housing agency, there's been a concerted effort across the country in housing agencies trying to, pair up their guidelines and not have, all these overlays. They may have some differences, but even though they do vary program to program, I would say, you typically need a credit score of around 620. In a lot of programs, some may not even have a minimum guideline. They will just go with whatever the AUS says. Some may have, a higher guideline, but that is a myth that you have to have perfect credit. Obviously, a 620 credit score is not a perfect credit. So,
And Angie,
turn
do
it
you have
over to-
anything? Thanks.
I agree. You have to establish that your borrower has, a representation of financial ability, right? Goes in line with your income, goes in line with other things. But you have these programs that, like Tonya said, will go off of your AUS. If you have AUS approval, they'll follow that. You have programs to 620, you have programs to 600. Borrowers can have those imperfections. It doesn't all have to be perfect, but you have to establish that they have the ability to repay that loan, and have proven themselves to do that.
Great. Well, now we've gone over the 10 myths of down payment assistance, and we really appreciate it. Angie will be going over just a few tidbits on the CalHFA Dream Program. It's only because in California right now, the real estate agents, everyone's asking us questions. So we just wanted to bring a couple little tidbits to you. So Angie, are you ready to go?
I'm ready.
Okay.
So the CalHFA Dream for All is back, or will be back in April, but they've given us some tidbits on what's happening, and they have restructured the program. Obviously, I don't think the first go around necessarily met all of who they thought their borrowers were, in a sense of who they wanted in that pool, but it is now going to be pool-based. It's still the same 20% of the purchase price, or $150,000, whichever is lower. So at minimum, you have $150,000. I mean, you can have lower, obviously, based off 20% of that purchase price. But repayment, you would repay the loan. And in addition, when you sell the loan, or when you sell the house, not the loan, when you sell the loan, pay off, oh my goodness, sell the house, pay off the loan, you will it depends on the value of that home at that time. So there will be appreciation paid back in addition to the loan to FHFA, depending on the value at that time. So you don't, if say homes started depreciating at a rapidly pace and you do sell that house, you may not have appreciation, right? That you have to pay back. You definitely have to pay back the loan. That will always be the case, but the appreciation part depends on the value of the home at the time of sale. Pre-registration process. So that's the difference to this program. The borrowers do have to go through a pre-registration. So they get a wonderful pre-approval letter from their loan officer stating they are qualified for the program. The borrower then, once the portal is open, which should be April 1st, the portal opens up from FHFA. The borrower submits their pre-approval letter and they start a pre-registration process. FHFA then takes it from there, decides they look at their first generation home buyer. They will verify that the borrower is a first-time home buyer. The first generation home buyer piece, the borrower cannot have owned a home in the last 7 years. Cannot. So that's a 7-year requirement. In addition to that, their parents, and this is both sides, mom and dad. So if you have divorced parents, you still have 2 parents. So both parents must meet first generation where they cannot currently own a home. The parents can have owned a home and can have owned a home in the last 7 years, can have owned a home last month. As long as they currently do not own a home, the borrower would qualify for that. And then you have obviously foster parents, you have other kinds of amenities with that, but that is first generation. So, but FHFA will do the background investigation on that piece. So once that borrower is accepted and receives a voucher from FHFA, they're good to go. The lender at that point does not have to verify anything additional to verify first generation. FHFA takes care of that part. And that voucher is good for 90 days, meaning that the borrower gets the voucher based off a TBD property. You do not have to be in contract to get that voucher. So the voucher is issued. You go work with your realtor to find a home. You submit the loan to Mountain West Financial, because that's where you're going to go for all of these loans. And and then we register that file. So as long as the 90 days, you find your house and you register the loan with FHFA, you're good. It doesn't matter if you close that loan in 30 days and 60 days after that, as long as you've registered that loan with FHFA and found a property. So it's going to be a good program. I know that, everybody's concerned about the first generation, but remember, the parents just can't currently own a house. So that's the caveat to all of that. So,
And it's only one person on the loan, correct? That has
correct.
to have
Sorry.
that. So
Only
if there's
one
2 or
person.
3 people on the loan, only one person has to have that first generation.
Correct. Only one
Okay, great.
person has to meet that. But this
Perfect.
program is in California only, unfortunately. But hopefully, Lakeview as a servicer is out there with other programs. Maybe they'll expand. You never know. We'll see how this one works, and hopefully they can expand into other states with it as well.
Okay, perfect. And yeah, once again, this is the California program. We only brought it up on here because it's such a hot topic right now. We felt it to be important. But thank you, Angie, so much. Next, I have Samantha Steen with MGIC. She is our account manager, and she is going to go over how MI can allow your borrowers or your clients have affordable housing. Samantha?
Thank you. Hello, everybody. So let me go ahead and share my.
Do I have to stop sharing?
Let's see if it'll let me.
Okay.
How's that? Can you all see that?
No.
No, cannot see the PowerPoint. Okay. Do you see my screen?
We see you, we don't
Just
see
your-
You
PowerPoint.
see
Yeah.
me. Okay, let's try her again here. Okay. Let me try now.
Yep.
There you go.
Okay, we are live and in business. All right, hi everybody. So yeah, I would like to share with you just a perspective on MI and how that actually helps all borrowers. So there are no income limits. There are no first-time homebuyer requirements. There's no geographical restrictions. MI is there to help homeowners or either buy or refinance with either less than 20% down or less than 20% equity. So in my opinion, it's one of the greatest low down payment tools ever invented, and MGIC is actually the creator of modern day private mortgage insurance. So, we're certainly talking about one of the biggest obstacles to home ownership. Certainly that's down payment. If you look at any surveys done by NAR, Fannie, Freddie, different investors, regardless of the market, down payment always continues to be at the top of the list as an obstacle. So let's talk a little bit about if you're a first-time home buyer and you go online to one of the popular real estate searching websites and you're looking at homes, you're thinking, okay, maybe is it a time for buy? Maybe my rent's gone up, and you come across this home, 4-bedroom, 2-bath, it's $545. And you look at the estimated payment and you think, okay, well, shoot, that's kind of right in line with my rent or not much higher than my rent. I think maybe I can afford this. Well, you might not be aware that all of the popular real estate searching websites all automatically default to 20% down. So if I'm the average consumer coming online, I look and go, oh, wow, I need $109,000. And that's where they stop right there. They are not talking to a realtor. They're not picking up the phone and calling a loan officer. They're thinking, well, I'm just not ready. I don't have $109,000. In fact, it would take most of us a number of years to ever acquire 20% down. Well, that's where mortgage insurance comes into play. Private MI, private mortgage insurance, PMI, we'll just call it MI for the remainder of our time together. That's where MI comes on the scene as the superhero, in my opinion, where we're ensuring that risk for the lenders when the borrowers don't have 20% skin in the game, right? That's what our insurance does. It's offsetting that risk when someone doesn't have 20% skin in the game. But for your borrowers, for your buyers, it's simply a low down payment tool. It means that they can get into the home without needing that 20% down thanks to mortgage insurance. So let's look at that same scenario, that same home. Instead of $109,000, they could put 5% down. So that's over $80,000 difference to this client. So imagine somebody looking and going, well, shoot, all right, I don't need $109,000. I can get in with 5% or as little as 3% down. And you just heard everyone speak about some of the great options for assistance on top of that. So not only do they not need 20% down, but they also can get assistance. So it's a huge game changer. So when you are talking to buyers, when you're talking to borrowers, you need to feel comfortable to help them understand that from their perspective, MI is simply a low down payment tool. So let's look at another example. Let's say somebody saved $20,000. Well, they can put 20% down on a $100,000 home and have zero left over. And I don't even know anywhere in the country where you can find a home for $100,000 anymore. Or put as little as 3% down on a $300,000 home and still have $11,000 left over in savings. Now, in this example, MI tripled their purchasing power. Now, we all know that that can mean the difference of an extra bedroom, a bathroom, a neighborhood, or a school district. So again, just another example of what somebody can do with the money that they've saved and apply that towards a down payment. So again, I like to think of it as a low down payment tool from the borrower's perspective. So it helps them buy a home sooner, right? Again, it would take most of us a number of years to ever acquire 20% down so they can get into a home sooner. They can also expand their financing options. So unlike FHA, private mortgage insurance on conventional loans can be paid a few different ways. It's also a temporary cost. So I like to say use it, then lose it. So your loan officers are going to be experienced in helping borrowers look at how long will they have MI, and once a year doing a loan review for them to look at when they can potentially drop MI without having to refinance. Also helps the borrower and the buyer keep more of their hard-earned money in savings instead of applying it all towards a down payment. Anybody who's owned a home knows that, you know, you need that little cushion for bumps in the road. Something goes wrong, you need to fix the plumbing, whatever it is, job loss, life changes. So keeping more of their hard-earned money in savings instead of applying it all towards down payment is also a very big deal. And then, of course, I showed the example of increasing their buying power. So MI is a great tool, and it's important that you feel comfortable helping your clients understand how to use it and take advantage of it. So with that, I'll kick it back over to you.
Awesome. Thank you so much.
Let me
And let's see.
stop sharing here. Do you have back control? Good.
I think so. Can everybody see mine now?
Yes.
Okay. Okay. Okay, so thank you so much, Samantha. We have a gift for everyone who is on the webinar today. We are going to send you a hyperlink. It's for down payment assistance. The hyperlink will help you with free leads. When you receive the email, you will need to copy and paste the hyperlink on your social media and your email. And as you can see right here, I don't know if you can see my arrow, but here's the hyperlink. So you would just copy and paste that into your social media or your email. And what will happen is that a potential client who may see this, they'll click on it, and then they will fill out some information, answer some questions. And when they hit submit, they will actually get back some of the information or the information on down payment assistance programs they could possibly qualify for. However, at the same time, you, the real estate agent, and the loan officer will also get their information. So this is kind of like a free lead. So these are potential clients. And if you have any other questions on it, then please refer that to your loan officer for more information. So we've gone through quite a bit today, and I just want to now open it up for any questions. Just if anybody has any questions.
Hey, Sherri, while they're gathering up questions in the
Yeah.
chat box or just online, you know, one of the things that, and you may have mentioned this, but just in case you didn't, you know, rent affordability is such a big issue for realtors and lenders right now. It's a national topic on the news. There was a news report just this morning that affordability for renters is the lowest it's been in 30 years. So it's a big topic for realtors for sure right now. And, you know, we've got 141 different down payment assistance programs. So there are lots of options. You guys have covered in great detail a lot of this information, but it's just such an important national conversation in terms of housing affordability throughout the country right now that this is really a timely topic.
Perfect. And are there any questions? Let's see.
Hey, Sherri, there is a couple questions in the chat box here. And for anybody else who has questions, feel free to open up that chat box and type them in there. We'll relay them out. So Sherri or Angie, if you guys have the answer to this one, they're asking if the Dream for All program includes non-borrower income. Yeah, all income would be included in the limits.
And will the California Dream subordinate when refinance? CalHFA typically does not subordinate. That would have to be on an exception basis. So your borrower would have to contact CalHFA and see if they would do it on an exception.
All right, I know another question we got earlier is if we'll have a recording available. I just want to let everyone know that this session has been recorded and we will be sending out the recording to everybody here.
Great. And then another question that just came in, they wanted clarification on the California Dream. Only one of the borrowers has to meet the first generation home buyer, and that is correct. Only one borrower on the loan has to meet the first generation requirement.
Correct.
Sal just made a comment that the DPR link, that's the hyperlink that we talked about, that it is that is great. Okay, any other questions? It doesn't look like we have any other questions. So first of all, I wanted to thank my guest, Angie, Tonya, and Samantha. Appreciate all your hard work. And thank you everybody for joining our webinar today.
Thanks,
Thank
everyone.
you.
Great job.
Bye, have a great day.
Bye, everybody.
Bye.